The Japanese yen rallying against the dollar today, hitting its highest level since January. It's a sharp move in the currency over the last month and comes as the Bank of Japan has taken a more hawkish tilt to its monetary policy and raised speculation of an unwinding of the carry trade between the U.S. and Japan. How much more deleveraging could there be? What could that mean for the market? Let's bring in FedWatch Advisors Chief Investment Officer and Founder Ben Emons. Ben, great to have you with us. We've talked about the carry trade in the past. It looks like the unwind is upon us, and I'm wondering, how can investors tell, how can you tell if we're near the end of that process?
Yeah, the one hand is difficult, Mel, because, you know, you're looking at that CFTC data too, and that's just a part of the market, right? We have the foreign exchange market that is so large with its FX forwards. You know, there's some data on the IMF side on that, and that actually shows more like a $4 trillion type of estimated position, and that's barely changed. So from the last time that we spoke about it, but also just the last sort of weeks, and the futures data indicates that too. If you look at the last few days, the open interest in these contracts for yen futures is barely shifting. So it looks like that as much as we get movement in the Japanese yen, it may not be really, you know, a major short covering just yet, or just not to the extent that you get real calamity. Nonetheless, you know, as a VIX today at 65 is clearly a financial distress moment caused probably mostly by the yen. I think that's the interlinkage. So my sense is there's more to go here, but it may need another catalyst, let's say data catalyst or BOJ catalyst, before we see more of this.
What would that catalyst be from your standpoint? Would it be a U.S. data point or would it be a BOJ catalyst?
I think it's more the Bank of Japan in this case because, you know, they actually got their intervention, right? We were trading 161 on the yen, and there was a lot of flutter in the market, a lot of speculation. When will they come in and do something about that? Now they got their intervention. And so the Bank of Japan, surprising with that hike last Wednesday, I think was obviously a trigger for people covering shorts. And you can tell from asset manager data, particularly futures, that was clearly happening. On the other hand, it's also about the Bank of Japan now having to hike rates because inflation continues to be high, but a currency that's already strengthened a lot. So I think the next Bank of Japan meeting will be the key meeting. It's not too far off from Jackson Hole. You know, what that could be, I think if they signal that they're going to be on hold, then I think the calm comes back to the Japanese yen.
Hey, Ben, Tim, maybe a comment and your view on my comment and then a question. But ultimately, should we be surprised that the Bank of Japan has stepped in here? I mean, if you're in the carry trade, you're a sophisticated investor. You're borrowing in one currency. You're going long. You're probably levering up dramatically to pick up a couple basis points. And this was the smartest guys in the room at Long-Term Capital back in the day. I'm just kind of curious, you know, why should a sophisticated hedge fund or professional investor be caught off sides by this move by the Bank of Japan? And then finally, where do you see credit?
Yeah, you know, the Bank of Japan is always sort of like very nuanced in its language. And it was difficult to parse the language, I think, Tim, going into that meeting. You know, we missed maybe Sarah, you know, probing the governor on Sintra, right, that she did last year. Then we got more signals out of him, and that wasn't happening before this meeting. So they just simply did surprise. And it is in the history of the Bank of Japan. Like Kuroda has done this a few times too. So, you know, I think that's the reason why these funds, particularly CTAs and lever funds, got caught off guard. But I also have to note, though, that I think it's also about people getting worried in general about the environment. So the yen is a flight to safety, you know, instrument, flight to safety generally. So I think that played a role here, too, because we did have this geopolitical sort of environment, sort of context of Iran playing in the background as well. And lastly, if you take that to credit, so credit spreads have widened a bit. It's still very marginal. If you think about it, if you price in that many quote-unquote emergency rate cuts, I think credit can only widen more if the yield curve particularly starts to steepen very aggressively. That seems, for now, a bit moderate. We're just flat on the 2-10-year spread.
So, Ben, everyone's focused on this direction right now. What's the knock-on effect? What's the next domino, if you will, that will fall? Is it the FX desks on a lot of these banks? What is the next thing? If this gets worse, what should we all look for?
Yeah, that's a tough one, Steve, because, you know, it's not necessarily the FX desk itself, because they pair positions. They're, I think, not the ones in the risk zone. It would be those funds that have borrowed yen and bought, say, AI stocks or other riskier assets. You know, we don't know the extent of that position, but there's some data out on it that it's in the trillions of dollars. And so that is, I think, ultimately the catalyst, that data watching is about, if we see more paring back, people start to pile on one another. I think that's also what happened overnight, because the move in the Nikkei really, I think, prompted a lot of people to cover their yen short positions while there's no liquidity. So I think that is the data watching, the positioning data.